Hi, I'm Joe LeBlanc, and this is the Premier Money Minute. We're back for part 2 of some of the lessons from the Great Recession of 2008. Some of the lessons we learned back then are: first, diversification still works. Investors that had their portfolio invested primarily in one asset class, for instance the S&P 500, suffered more than a 40% decline in 2008. If your portfolio had been diversified, including bonds and cash, asset classes that actually had positive returns in 2008, you would have suffered a smaller decline in the market and helped you stay invested, which ultimately helped you move through the recession and into the recovery. Number 2, don't take unnecessary risks with bonds. Something we're seeing even today is that the risk of bonds is very closely related to the duration or the amount of time of the bonds to maturity. Shorter term bonds tend to have less risk and less volatility as interest rates move. Longer term bonds have more risk and more volatility as interest rates move. Don't get caught on the wrong side with long-term bonds. We typically recommend short-term, high-quality bonds for client portfolios, and that's something you should strongly consider as we're in an environment where interest rates are bound to go up over time. Please join us next time for more Money Minutes.